Here's a rapid-fire update on all 35 stocks in Jim Cramer's charitable trust, the portfolio we use for the CNBC Investing Club. Jim ran through each name during our June monthly meeting on Wednesday. Join my Patreon for more investment insights and updates. Apple AAPL. Despite being somewhat expensive, Apple's services revenue and emerging markets business are still expected to grow, making it a stock worth owning. Advanced Micro Devices, AMD. While investors should consider taking profits, AMD's personal computer revenues are stabilizing, and it remains a strong contender in artificial intelligence chips. Amazon AMZN. Although Amazon's cloud computing business growth may be slower in the current quarter, increased adoption of AI workloads and internal efficiency improvements should drive future value. Bausch Health, BHC. There's no reason to buy this lackluster pharmaceutical company despite the worst being priced in. Caterpillar, Caterpillar's shares have risen significantly, and the company's non-cyclical nature and increased dividend make it an attractive option. Costco Wholesale, we sold some Costco shares to secure profits, but we still consider it a best-in-class retailer. Salesforce, CRM. Investors should hold on to Salesforce stock, as its long-term prospects in the enterprise software market remain promising. Coterra Energy, CTRA. Despite recent challenges, Coterra's capital return program makes it a stock worth owning in the long run. Danaher, DHR. As the biotechnology industry recovers, Danaher is expected to improve, and a favorable environment for public offerings could benefit the company. Disney, DAS. Disney's stock is undervalued compared to its historical average, and its potential dividend reinstatement makes it an appealing long-term investment. Estée Lauder, EL. Estée Lauder's struggling segment needs signs of recovery before considering adding to our position. Emerson Electric, EMR. Emerson Electric shares are gaining momentum, and we're willing to hold on to the stock despite recent circumstances. Ford Motor, F. Ford's cash flow outlook is uncertain, but the company has been performing well and making profitable cars and trucks. Foot Locker, FL. CEO Mary Dillon's ability to turn around the sneaker retailer makes it a stock to watch, although patience is required. GE Healthcare, GEHC. GE Healthcare's standalone entity status positions it for accelerated growth, particularly with the increased demand for MRI machines. Alphabet, GOGL. We're satisfied with our remaining position in Alphabet, and investors should wait for weakness before considering adding more shares. Halliburton, Halliburton's performance depends on a sustained rally in oil prices, so we're not currently betting on it. Honeywell, HON. If the market rally broadens beyond tech, Honeywell's shares may rise, making it an attractive option for investors. Humana, HUM. We bought more Humana shares, taking advantage of an excessive sell-off and having a positive outlook on its fundamentals. Johnson & Johnson, J&J. Due to ongoing talc-related lawsuits, it's advisable to hold off on buying Johnson & Johnson stock. Linda, LN. Linda's all-time high stock price may attract more investors and push its stock even higher. Eli Lilly, LLY. Eli Lilly's strategic investments and potential approvals for its diabetes and Alzheimer's drugs make it a promising stock for the future. Meta Platforms, Meta. Instagram's improvement, driven by AI and cost reductions, may result in a strong quarter for Meta. Morgan Stanley, MS. We are disappointed by the news of CEO James Gorman's retirement, considering his successful turnaround of the once struggling franchise. A decision regarding his replacement is expected by the end of the year. In the meantime, it's worth noting that the upcoming IPO of fast casual chain Cava has sparked hopes that the IPO drought is coming to an end. If this happens, Morgan Stanley, one of the underwriters for the Cava deal, should experience a much-needed boost in its investment banking division. Microsoft, MSFT. Despite some apprehension due to the excessive praise directed towards Microsoft, there's no denying its strong position in AI, which will benefit both its cloud computing unit, Azure, and its Windows and Microsoft 365 software offerings. Admittedly, after the stock's impressive surge of over 40% this year, there is a hint of greed. Similar to Alphabet, we advise investors to consider adding to their Microsoft holdings during a market pullback. NVIDIA, NVDA. As a chip designer and AI enabler, NVIDIA has become one of Jim's own it, don't trade it stocks, much like Apple. However, with Nvidia's substantial rally this year, nearly tripling in value, it highlights the importance of taking profits off the table to secure real gains. Investors with large Nvidia positions should not hesitate to trim their holdings. Balancing long-term optimism in a company with the desire to lock in profits can be a challenging conundrum. Palo Alto Networks, PNW. Our disciplined approach led us to take profits in the cybersecurity firm on Monday, following the official announcement of its inclusion in the S&P 500 index. It's possible to appreciate a company's prospects while taking actions to safeguard gains. Moreover, we are now better positioned to purchase more PNW shares in case of significant weakness in the future. Pioneer Natural Resources, PXD. Despite the retirement of longtime CEO Scott Sheffield at the end of the year, Pioneer remains committed to delivering steady capital returns, which we find favorable. Similar to our thoughts on Coterra, an oil and natural gas producer, PXD would benefit from a reduction in inflationary pressures within the industry. Procter & Gamble, PG. While our exposure to consumer packaged goods is limited, we believe P&G stands out among the group. We anticipate it will be able to sustain recent price increases and benefit from reduced input costs, leading to improved earnings. If our predictions prove incorrect, we will reassess our position. Starbucks, SBUX. Similar to Estée Lauder, Starbucks stands to gain from potential stimulus efforts in China amidst a sluggish post-COVID recovery in the world's second-largest economy. Constellation Brands, STZ. Powered by the success of Modelo Especial, which became the top-selling beer in the U.S. in May, Constellation Brands has shown excellent sales performance. Additionally, its strong cash flow positions STZ stock for long-term growth. Stanley Black & Decker, SWK. On Wednesday, we acquired 100 shares of this hardware and tools maker from the club bullpen. With a consistent track record of increasing dividend payments, we believe this fallen angel can successfully execute its multi-year restructuring plan. TJX Companies, TJX. As the parent company of TJ Maxx, Marshalls, and Home Goods, TJX remains an ideal investment for the current retail environment, where consumers are scaling back on spending. The management has demonstrated its ability to generate profits in a slowing economy. Wells Fargo, WFC. We maintain our trust in CEO Charlie Scharf's leadership skills to guide Wells Fargo out of its regulatory challenges. Scharf has made significant progress in improving the bank's efficiency while also delivering positive news on its business fundamentals. The recent announcement by the CFO, stating that Wells Fargo expects an upside to its full-year net interest income outlook with a projected 10% year-over-year increase, further reinforces our confidence. Wynn Resorts. Wynn. Just like Estée Lauder and Starbucks, Wynn stands to benefit from any economic stimulus efforts initiated by the Chinese government. Jim expressed interest in adding to our Wynn holdings if the stock price dips below $100 per share. With booming businesses in both Las Vegas and Macau, Wynn Resorts presents an enticing investment opportunity.